All right, welcome everybody. I think Rob just joined. You may have to unmute yourself.
Yeah, hey there.
There you go. Hey man, appreciate you joining us. I think we have about 20 some people, 25 people have joined so far, and I think we may have a few more that registered. So we'll give everybody a minute to join here. I think they'll just get started. So welcome everybody. So tonight we're going to have a webinar on advanced multifamily underwriting. So I have Rob Beardsley on the call, and he has graciously agreed to join us today. He actually wrote the book on the topic, so I'm pretty excited about this call today. Just a little bit of housekeeping. Everybody came in muted. If you have a question, just put it in the chat box and we'll address it along the way. And the other thing, anything you learn here is for entertainment reasons only. There's not legal or financial advice, so it's being recorded. So just be aware of that. So, I have the honor of presenting Rob Beardsley here today, and I was actually trying to find out what your actual role was from your website, so maybe you can expand on that in a minute. Lone Star Capital, and the reason why I reached out to Rob, I actually heard you on a podcast in the spring with what's his name, Hunter Thompson, and I was like, man, there's a guy that actually written a book on underwriting, and I'm kind of the love underwriting and spreadsheets and everything else. So I got your book and I read that and I got the model and everything else, and so it was super cool. And I've been doing these webinars since probably March, April timeframe, because I wanted to add some value. And initially it was just me talking to people. Then I realized I can probably add a lot more value by just reaching out to people and getting people on there. So I've had lenders and brokers and property managers and all of these other type of people on there. And sometimes I felt like who am I to reach out to people to ask to be on my webinar? But I felt like, well, the worst thing that could happen, people will say no. So I've just kind of emailed people and said, hey, you want to be my webinar? And this has been a lot of fun, and I can hope to continue to do this. And anybody who's on the call who has a topic they would like to talk about, by all means, let me know. I'll try to find somebody who can answer those questions. So that's what I want to do. So Rob, if you want to just talk a little bit about yourself and your company, what your title actually is, and why did you decide to write a book on underwriting? I think that was kind of an interesting topic here.
Yeah, absolutely. And thanks again for having me on tonight. Really appreciate everyone's time. Unfortunately, I'm not in a nice studio with good lighting, but I do have my mic, so we've got good audio. But wish I could be a little more presentable tonight, but that's all right. So for those of you who aren't familiar, my name is Rob Beardsley. I'm the founder and principal of Lone Star Capital. A couple years ago, almost 3 years ago, my business partner, Ken Petrikowski, and we founded Lone Star Capital to own and operate multifamily throughout Texas. Prior to that, I was working in multifamily with my family. I'm from Silicon Valley, California. My parents ran a residential brokerage firm, basically from home. And so I just grew up around real estate, around deals, and constant phone calls. So it's in my DNA, and excited to share what we're talking about tonight. So I'll talk about the underwriting. So underwriting was an early passion of mine. I always had an affinity for spreadsheets, for puzzles, and kind of love how things put together. And so finance and financial modeling is perfect for that. And multifamily underwriting, it can get complicated, but at the end of the day, it's pretty simple, and it's really reasonable for everyone on this call to become pretty much experts if they're willing to put in the effort. And I'd say I give people 6 months, 6 months in underwriting 100 deals. That's my advice. So why did I write the book on underwriting? I was so surprised that this didn't already exist, and when I began to learn, I thought for sure that this would exist. And it seems like a very big void in the market. It's such an important, critical piece of the business, yet people touch on it. People like to maybe dance around the topic, but I think one of the reasons why it has never been fully covered in this way is because people don't really want to lay their strategy or their methodology, right on the table for everyone to see, because it's then up for criticism. And so, I'm happy to be criticized because underwriting is an iterative process, and we learn every time we underwrite a new deal, and we learn every time we discuss a deal with somebody new. And obviously, my model, I didn't build it one time and then leave it. I built it, threw it away, rebuilt it, threw it away, rebuilt it, and then made smaller tweaks. And those tweaks come from having conversations with people like you guys tonight, with our institutional investors, with our, lender partners. So it's all about improving. So the definitive guide to underwriting multifamily acquisitions isn't just for sponsors looking to start or grow their business or, get more savvy in terms of identifying opportunity. I also wrote this with the reader in mind, from the limited partner perspective, passive investors. I think passive investors could benefit tremendously and do benefit tremendously from underwriting the deals that they're contemplating, rather than just consuming what is being fed to them by the sponsor and telling them it's a 20% IRR, it's this cap rate, it's this exit cap rate, and all that. So I think arming yourself with the ability to actually take what the sponsor's telling you, put it into your own model, and then, being able to have your own determination outside of what they're telling you can really empower you to make more confident decisions.
Yeah, no, that makes a lot of sense, because we, a lot of limited investors or limited partners have a tendency just to trust the DOM and whatever, and educating yourself on that is super important to make the right decisions if that investment makes sense. And I think I always try to share that with anybody I work with. So very good. Well, good job on that. And I'm sure you've gotten some feedback along the way that has helped you to further refine your model along. So that's super cool. A little bit about me. Sorry, I have actually my hand in my cast. If you see that, that's another topic. But so I'm Jens Nielsen. I'm the founder of Open Doors Capital, and we, similar to Rob, we do multifamily syndications throughout the country. I haven't really done any in Texas, but in Arizona and in Atlanta and up in Ohio and Pennsylvania. So a little bit in a few different markets. I live in Santa Fe right now. Some people may know me from Durango, where I was before I came here, but now home is Santa Fe, and we'll see where it takes us next. So very cool. So today's discussion topics is really I'm going to ask, just some questions to Rob he can answer, and then he's going to present his model a little bit so we can actually kind of dig into the nuts and bolts of how he approaches this. I think that would be really cool to learn. I'm also from an IT background and have spent a lot of time looking at different underwriting models. I haven't gone as far to write my own. I found some out there that worked for me, but I'm really excited about, sharing Rob's kind of thought process and see how that can improve our underwriting and the deals that we are doing. So right on. So let's see here. Kind of the first is a very broad question, right? But how do you approach the multifamily underwriting? What is your philosophy, and where do you kind of start when you go into looking at a deal?
Yeah. So this is definitely very broad and can be taken in different ways. So, keeping it grounded in reality, I'll answer this question with really the brass tacks and the nuts and bolts of what you need to underwrite. And so with underwriting, you don't, for every deal, you don't get the same numbers, and you certainly don't get them in the same format. So, typically people are asking for a T12 and a rent roll. Well, sometimes you only get a T5, maybe sometimes you get 2 years worth of historical financials. And maybe you get a rent roll, maybe you don't. And so the components that you want but don't always get are historical P&L, also known as T12 or trailing 12 months worth of historical financials, a rent roll, as well as some sort of offering memorandum or just deck that lets you, usually has some shiny pictures and gives you more of a background. And sometimes if it's an off-market deal, there is no OM, which then maybe you have to do a little more legwork, or, not just take in the information at face value. Similarly, if you're missing the rent roll, you might have to construct the unit mix from information that you find online. But basically, those are the key components that you need, because the bare essentials of an underwriting are just a couple of things. We need to have a unit mix, which is basically giving a breakdown of each individual floor plan in the property, how many units per floor plan, square footage, in-place rents, and then the most important component of all of this are your pro forma rents, especially if you're talking about value add, which so many of us are in the business of value add. And so that's, plugging in the existing numbers is the easy part. The really hard part is to take what is existing and then make projections about the future. And so that unit mix is easy to construct based on the rent roll and what's currently happening. But then that pro forma rent piece is something that we spend a lot of time on, making sure that we are, really nailed down there. But when we're just preliminarily going through the motions on just approaching underwriting, we'll just maybe slap a number in there that, we high level feel is appropriate. For example, if the broker says, they call us up and say, oh yeah, you can renovate these units and get $100 rent pop, right? We'll say, okay, fine. We'll believe you for now. And we'll just plug in those $100 rent increases on the pro forma rents. And then obviously we'll look to support that through rent comps as we dig in further. But if the deal doesn't pencil, meaning it doesn't underwrite to our goal returns at what the broker's telling us, let's say those $100 rent increases, then we can just pretty much forget the deal. Because if it doesn't work at that level, then when we hammer the deal and get more conservative and bring those rent increases down to where we feel more comfortable, we're just going to be further away from the price. So that's our general approach. At least for me, the way I like to start is high level and just kind of put the model together so that it's working, and then refine different things. And, the key things to refine, as I mentioned, definitely pro forma rents, your growth assumptions, and then your exit cap rate, which determines your terminal valuation or the price that you're selling at, which, especially for value add, over half your return could be banking on, that exit. So if you're overly aggressive on your exit, you might be compensating unrealistically for that. So yeah, it's kind of, I could go on just forever with this open-ended question, but I definitely don't want to ramble.
No, it's really awesome. I think that's an awesome approach there. And I love what you said about exit cap rate, and because that's such an easy number to manipulate to make your numbers work, right? What are you currently doing? Well, how are you conservatively estimating your exit cap rate at the moment?
Exit cap rate is everyone's favorite topic. And it's like you said, it's easy to manipulate, especially when you think of it abstractly. For example, if I told you, oh, we're underwriting this deal to a 6 cap, and let's say maybe the right number is 6.5, to someone who is less familiar, the difference between 6 and 6.5% can seem trivial and doesn't really, what does that even mean? Or is that a big move? So you always have to look at how your exit cap translates to your exit price, and then kind of sanity check that and say, okay, well, on a price per unit, on a price per square foot, does this exit cap rate make sense, right? Our input may be the exit cap rate, but then obviously our output that is calculating is, are we selling this for 100 a unit? Are we selling it for 200 a unit? And is it reasonable? So exit cap rate, we always need to sanity check it. And today, the way that we're looking at exit cap rates are pretty much still looking for that, I would say, 50 basis point increase off of where the market's at today. And the nuance here is a lot of people run the simple calculation of they're buying at a 5 cap. So they're going to raise the exit cap rate by 10 basis points per year, which on a 5-year plan puts them at a 5.5 cap, and they call it a day. The problem with that is many deals are purchased that have an implied upside in them. So often you're buying a value add deal at a 5 cap, but you and the seller and the open market all know that there is increases that can be achieved at the property. So you're going to pay for that in the price, unless nobody in the market knows and the seller has no idea that that's available in the market. But people are smart. The market is efficient. So you and the seller in the open market know that when you're paying that 5 cap, you are still getting some implied value there. So you're buying at a compressed cap rate. So the true market cap rate for a stabilized product is maybe 5.25, maybe it's 5.5. So really the appropriate thing to do, assuming that when you go to sell in your 5 years, you will be selling a stabilized product, not a value add product, then the appropriate thing to do would be to take 50 basis points over and above 5.5% and not 5. I know that we might have lost people there, or that might get confusing. But the point is, you need to focus on market cap rates and not just the cap rate that you're buying at. Because just because, let's say I decide, hey, I'm going to overpay because I have a 1031 exchange, or I have some other motivation and I want to overpay. Well, just because I overpaid and paid a 4 cap doesn't give me the right to now sell it in 5 years at a 4.5 cap. So again, relying on the market and through data is really the best way to derive exit cap rates.
Very good. Awesome explanation. Thank you. Okay. So, I wanted to kind of get into your model because that's one of the reasons why we're here, So how does it differ from other models that you've worked with? Obviously there's plenty of them out there, but you always chose to write your own. So there must have been something you didn't like that you incorporated in yours.
Yeah, so this is a great question, and this is definitely an interesting topic. So while I've had experience with many models, because we have people sending us deals in their model, and then we kind of sift through it and look through it and have to make sense of things. So I have experience with many different models, but truthfully, I haven't really dug in deep on many models, except for mine. And the reason for that is starting very early on. When I was in the process of learning multifamily, it was actually my dad who pushed me and basically forced me to build my own model, because I said, well, doesn't it already exist? Can't I just go online and download a model? And he said, no, you're going to build your own, and it's going to be better than all the rest. And it didn't really make sense to me at the time, but turns out he was spot on. So what I did was I downloaded all the models that I could get my hands on. And then I studied them and took all my favorite pieces from the models, and then, created my own, and then started iterating based on that. So, with all that being said, kind of the key components of my model and why I like working with it and why I chose it to build it this way was, number one, simplicity. So I think there's always so many ways that you can make things more complicated and make things maybe more precise potentially. But I'm kind of a lazy guy. And so I like to be roughly right. And so really, to put it in the most concise terms, is I want to be as accurate as possible in my underwriting with the least amount of inputs as possible. So getting my most bang for my buck for every input. So that's simplicity. So I don't have a ton of inputs. I don't have an input for rent growth for every single month or every single year in the model and different things like that. It's just rent growth over the course of the hold period. Keep it simple. And the other simplicity that is actually surprising to not see in anyone else's model for the most part is all the inputs are on one tab. And I know we're speaking abstractly, and once we pull the model out, it'll make more sense. But I love the idea that on one tab is where you do your dirty work. This is where you crunch the numbers, where you input your assumptions, and then you can tab over to the pro forma tab or the summary tab or the sensitivities tab and just read outputs and not be confused by, well, is this cell something that I'm supposed to put something here, or is this a formula? And it just keeps you safe. So that's another simplicity feature that I appreciate. Getting into some other things on the pro forma side, if you're using a model right now that only calculates based on annual calculations, I would be a little weary about that, and demand that the model that you work with calculates on a monthly basis, because that's going to lend itself to be more accurate, because you're able to get more granular at the monthly level, especially when you're talking about value add and stabilizing assumptions, where you're taking 200 unit property from X rents, you're taking it to Y rents, you're spending X amount of dollars to renovate, factoring that all in at the appropriate timeline, you'd be surprised at how much of an impact that has on your model, where whether you assume that all that work and those rent increases get done in 12 months or 24 months, and how that exactly is calculated and achieved in the model, it can change the deal's return from, a 10% return to a 15% return or more. So it could totally change the return profile and lead you to make a decision in one way or the other.
Very cool. That's all. Yeah, and I appreciate the fact that all the inputs is on one page, because I've looked at other spreadsheets and you got to go 10 different tabs to make sure you got all the inputs correct, and that if you don't, it really messes up your numbers. So that's pretty awesome. Very cool. Well, one of the things that I noticed there, and I haven't seen in many other models, is you have operational shock and capital market shock in your model. I assume it has to do with kind of stress testing and so forth, but those are unique. And what exactly is the philosophy behind those measurements?
Yeah, so this is related to our refinance stress test. And so in my opinion, particularly when you're buying a property with a bridge loan, this is the number one risk, and this is the number one thing that you need to be paying attention to. And the reason why this is specific to a bridge loan and less so to a permanent deal is because when you buy something with 10-year debt, the likelihood of you spending the full 10 years and, let's say, not being able to implement your business plan, or the market being in a worse position than it is today, is highly unlikely. Everybody believes in America, believes that America will continue to grow. And pretty much you ask anybody, is America going to be, economically in a better place in 10 years from today? People are going to say yes, right? Just because we have growth. And so typically, right, even if you don't get a lot of things right, growth will bail you out over the longer term. Now, where people get in trouble is when you are banking on a 2-year business plan or an 18-month business plan. And that's where you need to make sure you're right. Because if you're buying a deal with a bridge loan that is a 24-month term loan, 36-month term loan, you need to be right, because the economy could be in a worse position period of time, or your business plan could be behind schedule and you could be in trouble. So what the refinance exit test does is it looks at your bridge loan, and let's say you're buying a deal with a $10 million bridge loan. Your number one concern is that you're going in with high leverage. That's what a bridge loan is. It's typically 75 to 80% of purchase price plus your capital expenditures. So that's very high leverage. And what you need to implement your business plan and create enough value at the property that a new loan at a lower leverage point, call it 75% LTV, can support actually taking out the old loan. So if you went in with a $10 million loan, you need at least a $10 million new loan that is calculated at a lower leverage point to be able to pay off the old loan. So, and what we do is we stress test our assumptions, and we say, well, operational shock. What if we get our revenue number off by 10%? Can we still have a high enough value to support taking out the bridge loan? Yes or no? Typically it's yes. I mean, if you've got a good enough value add, you're creating enough value that even if you take a 10% revenue hit, which if you think about 10% revenue, that's typically going to be a 20% at least decline in NOI, because you've got a 50% expense ratio. So that's a big decline in NOI. So you should be able to pass that test. The next test is capital markets shock. So capital markets are, the debt and equity markets, basically referring to valuation and interest rates. So in the capital market shock, we keep our operations the same as our pro forma. We say, okay, let's say you hit the business plan right, but let's say the market is a mess when you're looking to refi out of your bridge loan. Let's say interest rates are up, cap rates are up. So that means the value that lenders are putting on your asset is lower. Even with higher interest rates and lower valuations, did you still create enough value to be able to take out your bridge loan? That's the capital markets shock. So typically what we're doing is we're taking cap rates up, I believe, 15 to 20%. And then we're also taking the interest rate up by the same 15, 20% and looking to pass that test. And then finally, what you didn't include in this question is the big one, which is the both shock. And that's where you shock the operations and at the same time you shock the capital markets. And that often kills it kills most deals. And what's scary but interesting about that is, if you think about it, when your operations when you think about a recession and a real market dislocation, that's typically what happens, right? The hardest ones, like so many years ago in 2008, not only did rents go down and your income went down, but also the capital markets were in a disarray and you couldn't refinance your debt. And so it is important to kind of just keep your eye on that risk and see, okay, well, in that both scenario, how underwater am I? Because that could represent, in realistic terms, right? If you went in with a $10 million loan, and let's say that both shock says that the most a new lender is willing to give you in that both environment is $9 million. Well, realistically, what that means is you're going to be making $1 million capital call at that point and hoping that your investors step up and keep that deal alive. Because the worst thing you could do is sell in that weak market and actually realize that loss rather than, ride it out and hope for valuations to recover, which they will at a later time. So that was a ton, but that's definitely one of my favorite, things to think about, stress testing.
Yeah. And I think a lot of people kind of glance over that and it's like, we'll be fine. And, and especially if you have that short-term debt on there where you take on a lot of risk. If you had a 10-year term, you can ride out a lot of ups and downs in the market. But for something short-term, that's definitely a risk. Cool.
Yeah. And to be completely honest, we do not look at this if we're doing a 10-year deal. If we're doing agency debt long-term, we won't even bother to look at this because it's not never, but it's rarely a problem.
Yeah. But, if you're taking over a property with low occupancy or collection issues or anything like that, that may be the only way to actually buy that property, right? And you have to take on that debt. Okay. And another thing, I think another favorite topic of yours is preferred equity, and why should a sponsor offer that? Is that something you guys do? And how does that differ from other types of equity?
Yeah, I'm actually just putting a link in the chat because I just today released my new ebook, The Preferred Equity Manifesto. And it's a quick little read, but it really just goes from A to Z on preferred equity. If you're completely, you haven't heard of it before. So preferred equity, what is it? So preferred equity is a supplemental financing solution that straddles the line between debt and equity. So it has components of debt, such as it earns a fixed rate of return. It has certain control rights and remedies. And then on the equity side, it is actually legally an equity investment with its rights outlined in the operating agreement, something like a joint venture. And it also, not always, but at least in our case, it seeks to earn tax benefits associated with investing in equity real estate. So it's got pieces of debt and equity in it. And, the other piece I'll touch on is, what makes preferred equity really and why it works is having equity cushion. Just like debt, when a lender is looking at a property and they say, I'll lend at 70% of value, they're banking on 30% of equity cushion there that if anything goes wrong, that's the cushion that's on to protect themselves and earn their full return, even in a challenging situation. Similarly, with preferred equity, we're also coming in for us up to 85% of cost, and we're banking on that same equity cushion, although at a higher leverage point, to hopefully keep us safe even in a difficult situation. So the second part of your question is, why should a sponsor offer that? It's a very interesting question. Not many sponsors per se offer that. It's a new thing for us, and it's so you see it more often in the more institutional market, private equity funds and other, finance companies. They have preferred equity strategies, and they're typically a $5 million minimum or a $10 million minimum. And so we started our strategy in mind with filling the void in the lower middle market, non-institutional space of, I think, primarily $1 to $4 million equity checks for preferred equity. So we're targeting deals that are, really $40 million and less, preferably $30 million and less. And this is a space where, like I said, there's not many providers of the preferred equity capital, yet the demand is very strong. Sponsors, especially newer sponsors, are, they typically have less access to capital, right? They're not a big fund. They don't have institutional capital relationships. and they're typically syndicating their equity. So it's a compelling value proposition to come to a firm like us and get $1 million, $2 million, $3 million from one source in a much easier transaction, rather than passing the hat around to 100 investors and fulfilling the equity requirement. So I kind of pitched it for why you should partner with a preferred equity partner. Our side of the business, why should a sponsor offer that? It's a tough question, to be really honest with you. As a sponsor or a manager of a preferred equity investment, it's not terribly profitable. Syndication is much more profitable. So I don't think it's something that, everybody's going to wake up tomorrow and want to jump into this business. The margins are a lot smaller. We're doing it because we see it as a way to grow our business and be synergistic and eventually grow into one of these institutional shops that are, putting out $200 million of preferred equity. So that's our incentive, but it's definitely not going to make us rich in the meantime.
Got it. Okay. That makes a lot of sense. Thank you. Okay. So, obviously I wanted to kind of make this actionable and give Rob the opportunity to show his models. So I made a screenshot of it here. Obviously, if you can share, I make sure I give you permission to share your screen here. Let's see. Yeah, if you want to share your screen, I'd love to see kind of a quick walkthrough through your model. Maybe if you have, a deal that you have in there, and you can just kind of show how you look at it and the different tabs and everything. So, because I know a lot of people on this call are, people that do this and want to learn more about it. So I think that would add a lot of value to everybody.
Absolutely. Yeah. So I can go ahead and share anytime.
Yeah. So I'll start my share. There you go.
Okay. So let's see. Hopefully everybody can see the screen just on the summary tab here. Okay, perfect. So like we discussed earlier, and I apologize, this is raw. I just went into our files and pulled a random model out. And this is a model that I didn't even do. This is my analyst, was the one who underwrote the deal. So he could be wrong. I could be wrong. He could have written a note in here that is not for public eye, but that's totally fine. So let's dive in. So this is the inputs tab that I had mentioned. So actually I'll zoom out of it first. First, I just kind of want to show and show you that within the screen that you're seeing here, obviously it's too small to read, but this here are all the inputs that we need to really fully understand and evaluate a deal. So it's not very much. Like I said, we're going for bang for your buck here. So it's not like you need to go through a million different tabs and input all these different assumptions. We're trying to keep it as simple as possible. So let's start from the top, and from the top left, and then we kind of go like we're reading a bit. So the very first thing that we typically do when we get a new deal is we obviously need to know what is the pricing expectation. So we ask the seller or we ask the broker, we say, what is the pricing guidance? What is the whisper price, right? Whatever terminology you're using. And we'll put that actually here. So we'll say, oh, well, they want, 13 million, right? And so that way we remember, okay, this is actually what they want. And then when we actually play with different purchase prices, we are, we can tweak it and then not forget, oh, what did they want? So that's step number one. And then number two, like I mentioned, is the unit mix. Now the unit mix, often you can either copy it from the rent roll, from the offering memorandum, or even online, just going to apartments.com is, we sometimes have to do that. So here are the market rents. And I'll point out that these market rents are then calculated for an annual gross potential rent here. And then similarly, the pro forma rents, which obviously backed by rent comps, something that you should definitely spend a lot of time focusing on, are calculated here in terms of your stabilized gross potential rent. And then from there, we head through pretty much just an income statement, starting with the gross potential rent to other income loss items such as vacancy, bad debt, and concessions. And, something important that I want to note is, so what we're doing here is the one little nuance here is we're not just copying, what I'll do is I'll quickly find the financials for this deal. So operating statements, and this is their T12. So what I'm not doing is I'm not copy and pasting the market rent calculated here in the T12. The reason for that is we have a mismatch in a way between rent roll and T12, because a T12 is a 12-month, period of time. It's a historical, picture, whereas a rent roll is a snapshot in time. It's just one day. It's just that day's rent roll. And so the problem we have is rents change over time. And what we want to do is we want to have the most up-to-date numbers, right? Rents are up, rents are down, whatever it is. So what we do is, again, our gross potential rent here is calculated from the unit mix that we input as to where we see rents, roughly speaking, today. And then what we do to offset that, because you're likely to have a difference. For example, this T12 is showing $1,717,000 in market rent. We're showing $1,758,000. Okay, so we're not just going to give the sellers credit for free money that they don't deserve, right? What we do is we offset that with an appropriate loss to lease. So whereas their loss to lease is only $15,000, which gets them to a net potential rent of right around 1.7 million. Well, in our model, we've got a slightly higher gross potential rent and a slightly more negative loss to lease, which in the end gets us to 1.701703, which is to the dollar the net potential rent in the T12. So yes, we did a good job on this one. And I take no credit. So that's kind of a nuance there that I think is, helpful to understand and can maybe avoid some confusion. So, and again, we're paralleling the T12 and the stabilized columns, because it's, number one, super important to understand where we are, where the seller is, and then build our assumptions moving forward from there. So, here we're raising rents ever so slightly, bringing loss to lease to our typical 2%, normalizing vacancy. So, we're just kind of comparing what is and then making projections about the future. Same thing, we move now down to the expense side of the operating statement. We've got our T12 that needs to be inputted from the T12, right? And this is pretty much just kind of copy and paste 101 or 201, depending on what's going on. But you get those copy and pasted, and then we use certain metrics, certain guidelines to underwrite on a stabilized basis. I don't want to get too much into that, but basically it's through experience, through underwriting many deals, through working with your property management team to derive budgets is where you can create value and get more accurate on the expense side.
So see here, you don't make any assumptions of like reducing utilities or other things. You're kind of just keeping them as it was in the T12 there.
Yeah, this here, just looking at it, looks pretty vanilla and standard for us. Our payroll looks a little bit high, but it looks like this is a smaller property. So the payroll budget's a little higher. We're typically somewhere around $1,250 a unit as a base case assumption, but we're a little more expensive. Looks like the note is, this is based on the OM. So we took the OM at face value. We're not afraid to underwrite to lower utilities and get aggressive with reducing expenses. I think that's one of the best ways to find a great deal is find a deal that has too high of expenses, because I think there's more opportunity there than finding a deal that has low rents and where you're not paying for it in the price, right? It makes no sense to buy a deal where you can raise $200 on the rent if you're, paying for it by paying a 4 cap, right? So I see that happen less for expenses, baking in, the implied value creation through expense reduction is less prevalent in valuation. So now we've got through the expense side, and now we've got NOI and our cap rates. So here you can see the underwritten cap rate based on the T12 is a 5.5, but because we're actually reducing expenses based on T12 versus stabilized, not by much, but we're reducing them, the underwritten cap rate is just over 6. And so the difference there is the way that we look at an underwritten cap rate is we look at the in-place revenue minus our stabilized expenses to really get an understanding of what the real income in place is. Because, for example, let's say this is a mom and pop shop and they have no management fee. They hire their sister for 25 grand, or well, 250 grand. That's good for them. For 25 grand on the payroll. Now all of a sudden the seller's cap rate is 7%. Oh, this is a fantastic deal. 7% cap rate. Problem is, it is, that's not your expenses. Your expenses are needing to be adjusted based on how you would run the property. So it doesn't really matter in terms of a cap rate calculation, what how the seller's operating the property. So let's now move on to the assumptions. So we took care of it really quickly. The unit mix, operating income, operating expenses, and now onto some of the assumptions. So I'll, breeze through this stuff. Cash reserves, you got to have them. I wrote an article about it. It can be a complex topic, but for now we'll keep it simple. The way that we typically look at it is we're either reserving up 1 month's worth of operating expenses and debt service, or 2 months worth of operating expenses and debt service. And we make that a determination whether it's 1 or 2 based on the risk of the project. Usually the determining factor is whether the deal is a bridge loan deal or not, with a bridge loan deal being more risky and therefore we want more reserves. Now, these are our debt assumptions, pretty straightforward, plug them in. And then this is the interesting piece. Again, this is what I would say, many models look the same and many models act the same. Where they're the most different is the stabilization assumptions. So everybody, the way they calculate renovations and they calculate rent increases is all very unique. And so again, I'm a simple guy, and the way that I tried to think of this and implement this is as simple as possible. So what I did is I created some more variables. I chose stabilization months, which is basically the amount of months that we need to implement our business plan. And specifically implement our business plan, what that means is a couple things: to get our revenue from in place to stabilized. And that includes taking the vacancy. Let's say we're buying a deal with high vacancy, 30% vacancy, and then the stabilization is 24 months. It's going to take 24 months to get the vacancy burned down to 7, let's say. So that stabilization months is the time it takes to implement our business plan. And the way we calculate in the pro forma is linearly. So we take, let's say we're doing $100 rent increase, right? What we'll do is we'll chop that $100 by 24, and every month we'll just add linearly. So we're just marching linearly from in place to stabilization. Very straightforward. Obviously in real life, it doesn't work like that, right? You're going to have some months you renovate 20 units, some months you only renovate 10. But for modeling, I don't want to exactly try to model reality. I just want to give myself a good indication as to whether this is a good deal or not a good deal without overcomplicating things. So stabilization months, right? And then the budget, how much you're spending, and then the going in vacancy rate. So the reason why we chose to have a going in vacancy rate specific input rather than just saying, well, you're at 4%, just start at 4%. And the reason why is we've learned our lesson the hard way, and we understand that there's a very common dip in occupancy upon takeover. When you buy a new property, especially when you're buying a turnaround play, right? If you're buying a deal that has $600 rents and your business plan is to take those rents to $800, that's a material change, and you're likely requiring a re-tenanting of the property, a fundamentally different tenant base. And that doesn't happen overnight, and that certainly drives up your vacancy. So even if the vacancy on the rent roll today is 10%, if you're coming in with a heavy turnaround, you might want to do 20% going in. So that's another piece we added to allow us to kind of play around with the going in vacancy rate. Similarly, if I want to renovate 50 units a month, I'm going to actually have to create artificial vacancy, because as it stands, let's say this deal's sitting at 5% vacant. We have 120 units at 5%. We only have 6 vacant units at any given time. So you're restricted in that way. So you might want to actually create vacancy. And so that you'd underwrite that way. So I think these things, when you break it down that way, are simple components and make it an easier way to actually defend and support your business plan. Because if an investor that you're working with, or, a partner is questioning you and saying, well, how many units are you renovating a month? Or, you can kind of ballpark it just based on the numbers here. For example, we're doing 73. You can say, oh, well, 73 over 24 months, right? That's only 3. Specifically on this deal, it's a bit unique because I believe the way that we underwrote the deal was, this is during COVID times. And so with COVID, agency lenders are requiring a reserve holdback. And so this reserve is $1 million. And so we took that $1 million that the lender would hold back for 12 months. And we would say, when that comes back to us, instead of just giving that back to the partnership, back to all the investors, we'll actually take that and improve the property. So we're actually going to wait 12 months to get that money back and then renovate 73 units. So that's actually 73 divided by 12. So that's 6 units a month. Still very conservative in my opinion. So again, it kind of lays things out in a more clear way. All right, we're almost done. So stabilized assumptions, simple stuff. This kind of mostly goes back to the income side, but there's also, asset management fee, property management fee, and then you calculate your property taxes based on a millage rate as well as an assessed value. And, property taxes can be extremely complex and they're all over the place. So it's really specific to the county. And so, if you're in a county where it is crazy, you really should rely on a property tax consultant like we do. And then these are some scary inputs here that everybody talks about, the annual rent growth and the expense growth. So you often see, 3% rent growth, maybe even 4% rent growth. And, maybe you don't think much of it, but here, let me just show you the quick difference. So with just inflation, which just assumes that your income and your expenses just go up at 2%, which is roughly inflation, this deal is showing a 13% return. Now, if I take this number and do 3% and keep the expenses low, which is a common way to underwrite, not wrong, but a common, now it jumps to 15.4. So you boost it up by 200 bips. If you go to 4%, now you're up 17.5. And so this isn't wrong. I mean, we're talking about a deal in Austin today. I mean, it's kind of abstract, but Austin, Texas, right, is a tremendous growth market, and you absolutely can achieve 4% rent growth there. So it wouldn't be necessarily wrong to do that. It's just, what's your style and how do you want to underwrite? And so our typical preference is to, unless we absolutely must, we just want to leave rent growth out of our projections. And we just want to see if the deal can support itself just on the merits of it alone and the business plan. That's really, really hard to do in a top growth market where everybody else is underwriting to 4 and 5% rent growth, and you're just trying to do 2%, because people have pricing power at that point. They're going to solve for, let's say, the same return metric, the same return bogey that you have, but they are growing so much faster. So it's very hard to win deals that way. So that's just something to be aware of. And, if you're a passive investor and you're looking at a sponsor's underwriting, you could potentially kill the deal just by changing this one number, right? They might have 4% rent growth and you say, well, let's just see what happens at 2%. And you do that, plus you change the exit cap rate, it can completely change the deal. Another nuance about rent growth is the time period. So if you're underwriting a 5-year hold or a 10-year hold, I would argue that your rent growth assumption should be different, because there pretty much has never been a period in history where rents have grown unabated anywhere at 3% for 10 years, right? Things go up and down. You have a year that's flat, you have some negative rent growth, and you have some positive rent growth. So it's the longer your hold period, the less inclined you should be to actually want to factor in rent growth into the model, because it just becomes more dubious. So, and the last nuance on rent growth is particular to our model here, which is that we suspend any of this rent growth here, this inflation, during our stabilization period. So for the first 24 months, as we're working on our business plan and we're really working hard to get to these goal rents, we're not just growing rents as well on top of that. So that's another nuance. So in this deal particularly, we have no rent growth for the first 24 months, and then we grow at 2% from here on out. Then you got other escalators, you got vacancy, simple stuff here. And then I want to get to terminal cap rate, which we already touched on. And basically this is where you input this very important number. And just want to give an example. Obviously this is an overgeneralization, and I'm not arguing that this should be a 6 cap deal, but if you look at a 5 cap, it means the exit price is $131 a unit. If I change it to a 6 cap, it brings it all the way down to 190 units. So I just lost $20,000 a door in value. I think it's a couple $1 million just by going from a 5 to a 6 cap, which may not seem like a big difference. So always need to sanity check your exit cap rates and, have it ideally supported by sales comps. So I'll leave it at that. We just, in record time, walk through pretty much every input in the model. So it's just that simple.
Go back to your cap rates based upon your expenses. Just scroll down a little bit on the left there, because you have kind of the 5.53. That's your based on the T12. Then you have a 6.02 and a 5.44. What are I guess I'm not clear with the two.
Sure. Yeah. So yeah, good question. So the 5.53 is the T12 one, and honestly, we don't care about that one at all because it's not real to us, right? We want it based on our expenses. So this is the real one, the underwritten cap rate and DSCR. So this one here now is a return on cost measure. And this is potentially, if you're going to take one thing away from this webinar, a return on cost is the most important metric of all of underwriting. So sorry to bring it up at the very last second, but this is the most important number. And so what a return on cost is it's kind of a smarter cap rate. And so the way it works is you take your pro forma NOI. In this case, it's 780. So, our business plan takes the NOI at 710 up to 780. So our return on cost takes 780, which is our pro forma NOI, and it divides it by our costs associated with achieving our business plan. And what are our costs? Well, there are our purchase price and our capital expenditures. So if I'm buying a deal for $5 million and I'm doubling the NOI, but it's going to cost me $5 million in renovations to double the NOI, I need to factor that cost into my equation of, is this a good deal or not? Am I getting a good return for spending this $10 million in total? So it's the same here. So I've got a little bug here because of the interest reserve being factored in, but that's not a real cost because it's going to be returned to me. So I need to just get rid of that. So when I get rid of that, I get a 5.83 return on cost, which if you can see the formula, it's F40, which is our NOI, and then it's our purchase price, and then it's our CapEx calculations. So it's literally that simple. Our pro forma NOI divided by our costs. And as you can see, a 5.83 return on cost, okay, is it good or is it bad? And that's kind of the next question. So like I said, it's the most important. If you could only have one number about a deal, it would be the return on cost because it's the least able to be manipulated number. You can't rent growth on this number because it's an untrended return on cost. It's simply when you stabilize, this is your number. So it's untrended. And then similarly, it's unlevered. There's no debt that we're layering in here. So we can't pump up our numbers through, low interest rates and debt and this and that. It's an unlevered number. There's no debt involved. So that's why it makes it the truest metric. Now, the piece that you are missing from just knowing this number is you need to know what the market cap rate is, because is a 5.83 return on cost for this deal good or bad? Well, if you're going to sell at a 6 cap, that's bad because actually you're destroying value. It cost you 5.83, percent to build these cash flows, if you will, and you're going to sell them at a valuation of 6. So you just destroyed value. Now, at the same time, if you're going to sell this property at a 5 cap, well, you created value because you were able to actually create an income stream on your cost basis at 5.83%, and now you're able to sell that income stream at 5%, which is going to, you know, take you up to a higher value than your cost. So that's the math there. And the final piece, and then I'm done, I promise, is risk and time. So there's no time in this formula. And that's why we don't just underwrite and look at return on cost and call it a day, right? We have time, we have growth, we have risk. And so what you need to understand is, you know, a 5.83 return on cost is not the same as a 5.83% return on cost that took you 2 years and a ton of risk, right? If I could just buy it and do nothing and get that, right, that's obviously a lot better. So I highly recommend you guys start focusing on this number and just paying attention to it. And then you get reps and you can see, oh, well, you know, it made sense here, it didn't make sense here. And you'll pick up these nuances along the way.
Very cool. Awesome. Yeah, I don't think many people use return on cost in their models, and it's awesome to include that. So very good. So that was kind of like the base model there. And then you want to just show the pro forma, that's kind of the annualized, that's the return per year then, or that's, okay, that's like your.
This is just, you know, the income statement with the pro forma, starting with revenue, expenses, then we hit NOI, and then you've got below the line cash flows, like asset management fees, and then debt service, and then you get to free cash flow. And then from free cash flow, then you've got metrics, valuations, cash on cash.
Do you have your annual CapEx reserves above the line or below the line?
Above. So
okay.
Here.
Got it. Yeah.
Yeah. Cool. So I'll also just point out, since we got on that topic of return on cost, here it's labeled stabilized yield on cost, same concept. So what I like about this is you go to the unlevered and just the purest number, which is that return on cost, and that's here, 5.83%. And then you go to an unlevered IRR, which is similarly unlevered. So it's, you know, more pure, if you will. But what the difference between an unlevered IRR and your yield on cost is you're actually now factoring in the sale into the calculation. Whereas the return on cost, we were just simply taking our pro forma NOI and dividing it by our purchase price and CapEx. Now with the unlevered IRR, the reason why you're getting a 9% unlevered return and not just your 5.83 is because, like I said, when you sell at a 5 cap, you're creating value. And so that your return, if you bought this deal unlevered, you would get, roughly speaking, 5.8% cash flows. But then when you sold, right, you would have a windfall, and that would get your annualized returns up to 9%. And then we take it up to the next level, which is levered returns, right? So we went from yield on cost, unlevered IRR, to now levered IRR, which obviously just factors in debt. So, you know, that's found on this here summary page, which is really just focused on touching on all the high points of the deal. Very
good. Awesome. Thank you. And we already kind of over time. I don't know if you have, Rob, you have a few more minutes. There were a few questions that came up. I'd love to maybe answer those.
Sure.
Let's see here. So there's a few questions. So somebody asked what RUBs are, and that Danny actually answered that. So that's basically just billing back utilities to the tenants, splitting it out if they're not metered. Jeff asks, can you clarify if market rents are what is actually being collected on the rent roll, or what the rent should be based on comparables?
Yeah, good question. So in terms of our definition, in terms of this model, market rents are, it's hard to define, but they are the property's market rents. So it's not the market rents in the sense that market, but it's, reasonably speaking, what should this unit at this property be renting for? And then there's often a discrepancy between what market rents are and actual rents, because let's just say the tenant moved in a long time ago and they've been slowly seeing a rent increase, or, you know, maybe the tenant negotiated a discount or something. So that discrepancy is reflected in loss to lease. And so sometimes when we underwrite, let's say we are provided with financials that are cash accounting, and they don't show vacancy, they don't show loss to lease. All they show is one number, and they say, this is how much rent we collected. This is cash in the bank. So then we again, we have a couple approaches. We can just go off the rent roll and just plug in exactly the actual rents as they are on the leases, or we could use kind of general market rent numbers and then kind of create our own vacancy and loss to lease based on what we understand about the property. So you just need to really fit the way that you do this based on the deal. So typically speaking, though, what we do is we'll come up with the market rents often based on just the rent roll. And then we'll, again, where we get precise is where we offset it with that loss to lease to make sure that we're not overstating or understating the real deal income of the property.
Very good. Thank you. I think that was the only questions that were there. If anybody else has questions, put it in the chat window. And I'm going to stop your sharing here. I'm going to share my screen here. Okay. Let's see here. I don't see any other questions. So that's really, thank you so much for sharing all that. That's awesome. That's why I called it advanced, because I knew it was going to get into a bunch of topics here that may not be kind of thought of a lot, but you shared that really well. So the next thing, so Q&A, we had some of that. I think this is your contact information I found on your website. So if anybody wants a copy of that spreadsheet that you have, what's the best way to connect with you?
Yeah, so if you're not on our newsletter list already, the best way to get your hands on the model is to sign up for our newsletter list, which you can do so at lonestarcapgroup.com. So head over to the website. You'll see some links to click to subscribe to the newsletter, or download the free model. Check it out. Let me know what you think. Happy to collaborate. Somebody just asked, does the model like this also pertain to smaller multifamilies, 5 to 20 units? 100%. You can do 1 unit with this deal, or with this model. I encourage you to edit it and make it your own if that's what you need to do. But it works totally the way it is on smaller properties. Very good.
Yeah, so I encourage everybody to sign up for the newsletter and get a copy of the spreadsheet for yourself, for sure. So I was going to give you a book away, Rob. I felt like I usually do this. So there's going to be a question that comes up now. The first person who emails me the answer and your mailing address is going to win this book. I'll personally go and buy it on Amazon for you. So here's the question. Well, let's see if I can get it to work. Here we go. So you have to pay attention to get the answer. But you talked about operational shock. What does that mean? So give your best explanation in a few words. Email that to me. Here's my email address, and I'll send you a copy of that one. But I need to get your mailing address as well. So not like a couple of times ago, I actually said anybody who sent me the answer got the book, so that cost me a bunch of books for this one. So I'll get that out to you. So what is operational shock? Send me an email on that. And the last thing I wanted to just share is I do some real estate coaching. If anybody is looking to learn more about underwriting or anything else, I can take some students probably towards the end of this year. Just send me an email, and I would love to talk to you about that. And that's what I had for today. Rob, do you want to say anything else before we end today's session?
Thank you so much for having me. Had a good time. Anybody on here, feel free to reach out if you have questions. And like you said, highly encourage you, if you're going to ask the question, okay, what's the next step? I really want to dive in. I really want to do this. It really is my book. That's what I wrote it for. And I really feel strongly that it's going to be the best thing step-by-step wise to get you, going in the direction that you want to go. So highly encourage that. And yeah, that's about it.
Find it on Amazon, get a copy of it. Well, thank you so much, Rob. I really appreciate your time today. It's a lot of fun. And I will send everybody this recording so you can kind of go back and revisit some of these things that we went over today. So thanks again. Everybody have a wonderful evening, and I will talk to you soon. Bye.